Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, I think we'll just start. This is expected. I could have done this easily, yes, in a one-button studio. Just give the lecture facing a computer. But I still want to do this just for you guys who want to come to this lecture. I still believe being physically in one space is the right way for teaching and learning. I can see your faces, expressions at least. So I'll give you a very brief recap of what I... Huh? Yeah, I'll try to give you some bonus marks, yes. So I'll give you a very brief recap of the first several slides I have discussed yesterday of the price to book value of equity ratio. And it was very popular financial measure of security selection, of choosing the undervalued, overvalued stocks many, many years ago. When I say many years ago, I meant 50, 60, even 70 years ago, when Benjamin Graham published the phenomenal work of security analysis. So after the Great Depression and the financial market was in a mess, and the publication of security analysis was like a Bible for analysts and investors who tried to understand value. So that's the time when P ratio, price to book value ratio, and a series of other ratios became so popular and valid, useful tools in security analysis and understanding value. But after that, we understand what happened in the 80s, 90s, and after 2000 with the fast development of information technology and the very popular use of spreadsheet aided modeling. So the avenues of making a positive profit for investors by using these simple ratios has been wiped out. And it's very rare. Now the funds managers are still relying solely on these ratios in security analysis. But for us, the equity analyst, we try to understand the value of a firm. So these ratios are valuable inputs to provide marginal benefits for us to understand the value of firms, of our interest. So it's rarely that you're going to see equity managers will just rank the price to book value of Australian firms and choose the try to short the overvalued or try to get a long position of the undervalued. They don't do it. You won't get a positive profit by doing this kind of security selection. And if you run the back testing, for instance, for the past 10 years, 20 years, if you run the back testing, you couldn't even get a positive profit by using this PE ratio or price to book value ratio. So it's probably not a useful tool for trading over investment selection, security selection anymore, but they do provide some benefits for us to understand the value. So by playing with the formula a little bit of assuming a very long-term investment horizon, and we take a very long-term view of the company, and we assume the company is in a stable growth state, and there will be constant growth rate of dividends, and it's a mature industry. It won't be an electric car industry, and it won't be a startup pharmaceutical company. It won't be a startup information technology company. So it's a mature company, mature industry, and we have confidence to assume there will be constant growth rate of dividends originating from successful reinvestment of its profits back into the company. So the price to book value ratio can be represented in the equation. It's an increasing function of return on equity and payout ratio, and also the growth rate, the constant growth rate of the cash flow from investment, that's the dividends, and the decreasing function of the risk of the company. That's the R you see in the equation here, the cost of equity. So by playing with the equation a little bit further, we can rearrange the price to book value ratio to this. And if we do assume the G, the constant growth rate, is a constant, when the return on equity that exists, the difference between cost of equity over the constant growth rate, we're going to have a price to book value premium. The price to book value ratio of Woolworths is currently at about 3.5 times. So intuitively, over the past years, if you take a very long-term view on the company, starting from the first day of the equity investment in the company, that's every dollar of paid up capital in the company, that's the book value of equity in the equation here. And now your investment has grown into $3.5, or in other words, it's a 350 times growth over your $1 investment in the company, if we take a very long-term view. So obviously, Woolworths is trading at premium. How can we understand this premium? So if we plot the price to book value ratio over return on equity. Return on equity, that's just the ratio we calculate by dividing the earnings with book value of equity. So we try to gauge how much you have to pay for how much earnings you receive for every $1 of book value investment in the company. So if we plot price to book value versus return on equity, or earnings over book value of equity, we're going to have this nice trend line here. And this horizontal line indicates price to book value ratio of 1 time. So on this line, that every $1 investment in the paid up capital, that's the book value of capital of the company, you have $1. That's the investment of $1. Now the price, your investment result will be $1. So there will be no premium, no discount. It's just you don't have any investment return. Any area above this line here, that will be price to book value ratio above 1. So for every $1 of investment in the equity capital of the company, and that investment is worth more than $1. So that area, everywhere above this one line here, indicates a price to book value premium. And what about the companies below there? They are priced at a discount to the initial $1 book value investment. And they are sometimes called very cheap stocks if at the same time you will find a P ratio below the market average or industry average. They are so-called priced at discount. Are they undervalued, by the way? Are all the stocks priced at a discount? of the price to book value ratio or price to earnings ratio all undervalued? Are they undervalued? Here comes in the other idea of when we try to understand if this firm is generating value or destroying value for shareholders, is actually by looking at the relative size of return on equity and the cost of equity. So on this horizontal line here, we have the return on equity, and this cost of equity, required return by equity shareholders, is sort of at this rate given an equilibrium market outcome. Any stocks, when they can generate a return on equity exceeding the cost of equity or required return by shareholders, they are generating value for shareholders. So any companies to the right here, they are generating value for shareholders because ROE is exceeding the cost of equity. Now we have two dimensions to decide if a company is cheap or if the company is generating value for shareholders. Let's have a look at several examples here. For company A, it's nicely sitting on a price to book value ratio of 1 time. So it's fairly priced relative to its book value of equity, and its return on equity is equal to its cost of equity. Does it create value for shareholders? Maybe not, because its return on equity is equal to cost of equity. Is it priced at a premium or discount? No, it's so-called fairly priced because its price to book value ratio is equal to 1. So that's probably a quite boring industry, a boring company, and it doesn't really attract much investors' attentions. Now, let's have a look at company D. So obviously, company D is able to generate a return on equity far exceeding its cost of equity. Here. Is it priced at a premium or discount? Or premium. So that company is priced as price to book value ratio far exceeding 1 time, maybe 2 or 3 times. Is that Woolies? Is that Woolies? You don't know? Right. Just from this graph, maybe it's hard to tell because they are not scaled. But where are you going to position Woolies? We know currently it's priced at 3.5 times of price to book value premium. So it must be above this line, around here. And what about its return on equity spread over the required return on equity? Is it a positive spread or negative spread? Can you recall some numbers from your model? No? Okay, that's fine. That's fine. Yes, I know. It's quite overwhelming. So the return on equity, if you do price Woolies very close to the current market price, return on equity of Woolies is to the right of the cost of equity. So it's very likely to be in this territory or in this territory. Can we just say Woolies is overpriced or underpriced? we can't really say. But this graph shows us a way to understand or give us some indications. This company might be overpriced, might be underpriced. So if this graph is scaled, we'll see like probably 3 or 4 times of price to book value ratio and close to 20% of return on equity. And there will be a company in this position, maybe a little bit further than company D. And the company is in pharmaceutical industry. So, is this company trading at premium? Obviously, very much higher premium over book value of equity than other industries or the market average. What's the reason might be the premium of a pharmaceutical company trading at a price to book value premium? What's the price of to book value premium? That's the investment return for every $1 investment in the equity of a pharmaceutical companies. That's you're going to see your investment. So a higher premium means investors really put a much higher weight on its potential of generating value for investors. Or sometimes for some industries or some companies, the company might be in an investor hype. There will be some asset bubbles. It got too much attention from investors. Sometimes it's new industry and people put a lot of attention on the growth potential. And with this imbalance of supply and demand of the shares, you will see a much larger premium in terms of price to book value premium. These kind of companies and industries might be subject to bubbles, asset bubbles. So a price to book value premium may indicate the company is overvalued or may indicate the company does have the potential to generate a very strong value for shareholders. So that's, if we translate this graph to these nice squares, so with the high price to book value companies and at the same time they have high equity return spread, they are expensive for a reason, because they can generate a much higher spread of return on equity over the cost of equity. A lot of new industries or industries that you might forecast a high growth rate in the future might fall into this square here. Like electric car industry, some information technology startups, or some pharmaceutical companies that have the competitive advantage to maintain their high markup, high margin, and to deter any potential threat from new entrants. So they're going to fall into this square. With some companies, they are traded at a premium. In the square to the left, they are traded at a premium, but they are struggling to generate a return on equity, which is much higher, which exceeds the return of equity at very large margin. So these kind of companies will be some mature industries or companies are out of the fashion for investors. There might be some beliefs in the market belief they are still deserve this premium, but these companies are struggling. They are right in the life cycle stage of changing from the takeoff stage, transitioning to mature. They're going to see their margin is eroding, or they might be losing customers, losing market share to the new, more efficient competitors in the market. They are struggling with the return on equity. And at the same time, some investors in the market still believe because of the size, because of the existing market share, they might still have the potential to maintain the competitiveness in the mature stage. So these kind of companies might fall into this square. Another group of companies, they are trading at discount of price to book value ratio, but they are generating a much large margin of return on equity exceeding the required return on equity. So that's what you'll see companies see over here. These kind of companies that are in the industries, they are still okay because of the monopolistic competitive position. They might be the only key player in the very segmented market. They can charge a very high margin of their products. For example, Telstra. Obviously, Telstra is the key player in the telecom communication service industry. And if you look at the profit margin of Telstra, it's astonishingly high, 40–50%. So they can generate very high margin of return on equity over required return on equity, but you won't see Telstra is priced as high as the pharmaceutical companies, no matter its price to book value ratio or price to earnings ratio. Some companies may have lost the confidence in the investors. Currently, they might have these competitive advantages, but this is subject to some uncertainties in the industry. What will they lose the government quality protection? What if this sector is totally liberated and there will be no restrictions of foreign capital into the sector? And that's why investors do not put a premium on these kind of companies. For some companies, if they are in this kind of industry and if they have really big problem of their operation, they can have a very deep discount in terms of PE ratio or price to book value equity ratio, and they may be undervalued. So price to book value ratio has long been used by academics in academic research, but it's controversial in terms of security selection, but it does provide equity funds managers some indication of the relative pricing. I generated this graph to show you the price to book value ratios of different industries and the long-term average, the relative pricing, to give you some indications how these industries can be priced at this level and how would these pharmaceutical, that the bright blue color, could go up to 8.5 times of the book value of equity. So they are, obviously, they're driven by the price, which does not solely reflect value. It reflects a lot of things: noises, investor hypes, the relative supply and demand of the shares of the industry, of the shares of this kind of industry in the market, or it might reflect investors' preference over that period of time. So let's have a look at the world average. For long-term average from 1970s, that's a very long-term view, 40 to 50 years, it's at this line here, about 2 times. So it's will be the black line over here, 2 times. It tends to be quite stable over a 40-year period, and that's what you would expect if you invest in the a huge basket of listed equities in the world, and you expect it's trading at a price to book value ratio of 2 times. So for each dollar of equity investment, you expect your investment will grow to $2. So that's what you observe of the black line over here. Very sharp contrast is the pricing of pharmaceutical companies. They have always been trading at a large premium over the world average, or over the average company price to book value ratio. And that huge increase of price to book value ratio happened in the second half of 1990s. Probably it's a little bit far away from you. So we actually had oil crisis in the 70s, high inflation in the 80s, and the abandon of the old monetary policies in the advanced economies, and we had liberalization of several major industries in all of the developed economies in the world. That's why at the end of 1980s or early 1990s, we had a takeoff period of the world economy, no matter in the developed economies or the emerging markets. So if you can maybe recall something that happened in that year, over that 2 decades. So in the second half of the 1990s, that's when the economic development around the world was so robust, investors were so confident, and what happens when everyone is happy about the economic development? They're confident, and the interest rate is okay, there's no credit crunch, and the unemployment rate is okay, and the GDP growth rate of all of the major economies posted a positive number. So when investors are confident, what do they do in the investment world, in the financial market? Do they go to buy low-risk investment or high-risk investment to chase the high return? High risk, yes. That's what happened in the 1990s. So the valuation of pharmaceuticals, one dimension of that value is generated from the potential of growth. The drugs, the new equipments within their R&D, so that's something really in castle in the air, or partially driven by their competitive advantage, their ability to maintain the competitive advantages over potential threats. So when the market was really robust, the investors were confident, and that's when investors started chasing the high-risk, high-growth industries and companies. That's why you see the price-to-book value ratio of pharmaceutical companies was driven up to over 9 times. Obviously, it's much over its long-term average of 3.6 times of price-to-book value ratio. And we know what happened over that deep Asian financial crisis, and then over that time, we had the technical bubble in the US market, and there was a ripple effect into other sectors, other segments of the industry, of the economy. So it became maybe fairly priced after this bubble, investor bubble or investor hype just busted. That's the story of pharmaceutical companies. Now, let's talk about consumers. So that's Woolies. Will fall into the yellow line here. The long-term average has been about 2.8 times. That's the world average. Currently, the world consumers is priced as about 3.5 times. It's exactly the same price to book value ratio of Woolies. Okay, how can we understand the premium? We compare the 3.5 times over its long-term average of 2.8 times. Why? Why would see after 2011, we'll see the run-up of price to book value ratio of consumer staples. And also, if you have a look at the red line, consumer discretionary as well. And they are closer in recent years. What's behind the premium of consumer staples and consumer discretionaries? Yes? Sorry. Commodity, agricultural commodities. That can be a reason of driving up the premium. And we had this commodity slump of the minerals triggered by the global financial crisis. Then in the years after that, the other sections of the commodity market was very volatile as well. With the grains, that's any commodities related to food, coffee, sugar, the pricing was driven up as well. Partially because of the robust demand from the faster growth of middle class people, consumers in the emerging countries. Partially in some commodities was driven by the shorter supply because of long-term lack of investment. So for that entire 10 years of time, capital were flowing into minerals, so the metals, not really much into the food related. So that's actually, if you go to have a look at the stock market, that's a leading indicator of economic growth of all of the major economies. They actually follow that same trend line in recent 7 or 8 years. So maybe the consumer staples was partially driven by the commodities picking up, especially the commodities of grains, sugar, or coffee, but it's mainly actually the underlying driving force is the robust economic recovery of all the major economies in the world. In recent weeks, we had very volatile fuel prices, even the stock market as well, no matter in the US, Japan, and Australian market. So that is still robust. Although we have the threats of a high fuel price, the trade tension between US and its neighbors, with China, with European Union, but still investors are still confident of the economic outlook. So when the investors have confidence in the future economic development, they tend to buy discretionaries because they believe, okay, we do have a robust economic development. Consumers would love to spend more money on electronic products like new smartphones, some other cool gadgets, or even fast fashion items. So that's why we had a very good premium of the consumer discretionaries. The green line here indicates the building materials. It's a very cyclical company, and it's sort of considered as a boring industry. Innovation, potential of growth is very limited. They provide the building materials to the construction, for the construction of houses, construction of infrastructures. You will see it will actually go hand in hand with the world. That's the world average, or the world price to book value ratio can be seen as a composite of all the companies or all the industries in the economy. So they go up and down together. And they may be easily driven by any risk in the market. Like, for example, we now have much uncertainty in the Australian housing market, although we do not really have a housing crisis yet, but Reserve Bank of Australia analysts are watching closely on the Sydney housing market and Melbourne housing market of how much deep they're going to fall in the next 12 months. So it's really the price to book value ratio is still driven by the nature of the business, by the competitiveness of the companies within that index. How are we going to use this to round up your DCF valuation? If we have a price to book value ratio of Woolies at 3.5 times, how are you going to use this? Do you have any ideas? If we have multiple, like P/E ratio or EBITDA enterprise value multiple, how we use the multiples, the simple ratios? We just look at the ratio and say, okay, this company should be fairly priced, and we estimate a book value of equity and multiply that book value of equity with the P over BV and calculate a price. Is it how we use the multiples? Have you done anything about the P ratio or enterprise value multiples? No? Okay. We compare the company with its peer group. The absolute value doesn't tell much about it. We have to compare the price to book value ratio of Woolies to the World Consumer Index. Okay, it's fairly priced relative to the world consumer staple companies. But remember this, Woolies has a diversified portfolio of Australian food, 7% of revenue, and the other segments each contributing like close to 10% with exposure to liquor, New Zealand food, and department store and hotel. What are the companies in the yellow line here? If you have look at the consumer staple industries from data analysis, you will find out that line includes companies like Woolies and Coles. They are in the supermarket or grocery store, or they might just provide beverage to the market, like Coca-Cola, or they just in the wine industry. Yes? Yeah, they'll come to that point. This is the world average. You are right that Woolies generates like predominantly 90% from Australian market. So comparing to the world, that's a hugely diversified basket. It's fairly priced. What about Australian peer groups? When you choose the comparison companies or comparison industry average, which one is more appropriate for you to understand the relative pricing? Obviously, in this case for Woolies, Australian companies might be more appropriate in terms of relative pricing. So if you do want to compare Woolies against this world average, make sure you put a smaller weight on that comparison when you decide the appropriate price to book value ratio for Woolies. And when you have a look at the consumer staple companies in Australia, you have Wesfarmers, you have Metcash, and I provide you data of Coca-Cola as well. If you're going to choose one, which one is the most appropriate? Obviously, Wesfarmers. What about Metcash? Is it an appropriate comparison? Maybe. And for some reason, it might be trading at a premium or discount. What's the reason? They are in the same industry, same exposure to sub-industry of retail. What is it? The size. Size matters in pricing. So usually smaller size companies are considered by investors as riskier. So if you have a look at the price to book value of Metcash and Woolworths, what do you observe? Maybe you don't remember really the data. They are more probably priced at a discount to Woolies. That's just consider the risk. And Metcash has a very small market share as well. And is Coca-Cola an appropriate comparable firm? Maybe, maybe not. What about other companies in consumer staple, like dairy firms, or some companies related to the agricultural, the primary industry? Are they really good comparable firm for Woolies? Maybe not. So now, given the size of Australian market, we have only one good comparison, that's Wesfarmers. And here comes the complication as well. Okay, Woolies is just in retail, but what about Wesfarmers? If you have done some research on Wesfarmers, what does Wesfarmers do? Anything? What does Wesfarmers do? Fertilizer, energy, and service to the agricultural industry. So it got a very much more diversified portfolio than Woolies. And from your calculation of the rolling beta, is Wesfarmers beta higher than Woolies or lower? No, still can't remember? Okay, go back, check your model. I don't want to just spoon feed you and you get the answer straight from me. It doesn't get you to learn much. Go back, check your model. Is the beta of Wesfarmers higher than Woolies or lower, and why? Try to understand why. So when you compare the price to book value ratio of Woolies against Wesfarmers, it tells you why. Okay, that's I'll give you some indications how you might use the price to book value ratio to understand the value of Woolies. Yes. Aldi is not a new company. It's not a new company as well. It's new in Australian market for like a decade of time, but it's a conglomerate in the European market. It's huge. It's not listed in Australian market. So when you have a look at the price to book value ratio of Aldi, you're looking at the whole company. And you better have a look at Metcash. They operate in the same industry, generate revenue from the same market, and it's much, much smaller, got very much smaller market share compared with Woolies. And what would investor price Metcash against Woolies? That's a much better comparison. So another method in terms of asset-backed is the breakup valuation or sum of the parts. That's particularly relevant for Woolies because it can be modeled by business units, and each business unit you can get some very good idea of its gross margin, of its sub-industry, sub-sector of the retail trade. And you can find a comparable firm for each of its business units. in the industry. So we can just assume that the assets, the business operation of Woolies can be divided into these clusters of assets: Australian food, New Zealand food, liquor, and department store. So they have these several assets, and for each piece of asset, we come up with a valuation separately, and we sum up this valuation together, and we assume this will be the total value of the company. Theoretically, they should generate the same value as your enterprise DCF valuation model. But in reality, there might be some differences, because obviously for some business segments or some assets within the total portfolio of Woolies, they are like in some really big trouble, like the department stores, and for some time they might be valued, might be undervalued, or maybe it's fairly valued. We don't really know. And also that's the case for Woolies. When you sum up these different parts, the total value may not equal to your enterprise DCF valuation model by forecasting explicitly of the cash flow, the discount rate of the overall company. For some companies, especially operating in the Asian market, like in Japan and Korea and some Southeast Asian countries, they tend to have a very complex ownership structure. Like Toyota is the world's largest business group. It's got hundreds of companies. They have cross-shareholding, and they have very complex guarantee borrowing and business transactions within the hundreds of companies within the business group. So the pricing of this kind of conglomerates is usually priced at a discount to the total value of each individual company or each individual assets. Academics have been doing a lot of research work on this. They have all kinds of theories, like, for example, they believe with this kind of complex business groups, the founder actually set up this pyramid shareholding, cross-shareholding for a reason, to expropriate the minority shareholders. So for the minority shareholders who own like maybe 5, or for the individual shareholders, they're going to lose some value because of the dominant power or voting rights of these founding families or dominant controlling shareholders. That's one theory of conglomerates are priced at a discount to the total value of its individual assets. That's not a serious problem for Australian firms. They usually have a clear, neat ownership structure and not very much cross-shareholding, extremely complicated, large conglomerates. So this is an example of some of the parts. It's an example of Wesfarmers before the acquisition, of course. But it can still, you see, its business segments will be divided into hardware, energy, fertilizer, and the services to other industries. So what we're going to do is that we have these clearly divided business segments. We're going to estimate EBITDA for each business segment, and we decide an appropriate EBITDA multiple. Obviously, we are not doing the explicit cash flow or discount rate forecasting as what we do with the enterprise DCF valuation model. We decide an appropriate enterprise value multiple for each business segments. And these multiples are determined based on your understanding of the comparison of these business units relative to its closest competitor in the market, and you apply your judgment of a premium over the comparable firm or a discount over the comparable firm. You decide that appropriate multiple and multiply the multiple with your forecasted EBITDA for that business unit to produce a value of that business unit, and that will be the total value, about $12 billion, $13 billion. To decide a valuation of shareholders, okay, we still have debt, and we have 83 million of cash. So deduct the net debt from the total enterprise value of the company. We have the net value attributable to shareholders of Wesfarmers. That's divided by the number of shares, and you will have a value of the firm of $28. That's how we can apply the sum of the parts or breakup valuation of a firm. When we have a clear divided business units, and we can decide an appropriate enterprise value multiple. So you can apply this method to Woolies in a very straightforward way that makes sure you find a comparable firm that's appropriate for that business unit. Some judgment will be needed to decide that multiple. That's the example of Telstra. So with Telstra, it's a monopoly in the telecommunication industry. That's why you will see the EBITDA margin of some of its business segments was well above 50%. So still with Telstra, we estimate EBITDA for that business unit and decide an appropriate multiple and calculate the value, total value of the firm. And in this case, the analyst has generated like really a breakup. What if the government has this idea? Let's break up Telstra and let's make the highly concentrated market segmented to promote competition. So the analyst actually produced a per share valuation for each business segment to give you some ideas how this company will be valued by business segments if we just cut and divide it and list each business unit in the market. So you have an overall valuation of $3.34. Maybe you don't want to do something like this to Woolies. Any one method will be good enough to give you some ideas. The judgment involved in deciding the appropriate multiple for each business unit, and you got to focus on EBITDA or EBITDA. This can be done easily if you do have a forecasting model of its revenue by business units, and especially when you have a top-down method. You decide the market share for each of its business units, and you forecast explicitly the value, the revenue for each business unit. And then the past EBITDA or EBITDA margin will be good indication for you to estimate a margin for that business unit. So this should have been produced in your model already of segment analysis, and you only need to find out the appropriate multiple for each business unit. Takeover valuation is not this kind of required in very much details in this course, not required for the final exam, but it is part of valuation framework. So I provided several models in week 6 when we discussed the evaluation of the growth potentials. So if you're interested, you may have a look at, just get through these models and think about the possibilities of takeover valuations in evaluating an asset or business unit or standalone business. let's take 5 minutes break, then we'll discuss how we're going to apply sensitivity analysis and scenario analysis. All right, with the sensitivity and scenario analysis, they are very important tools in valuation to help you understand what's going on with your valuation model. And if you have been playing with your model, the KGW model, you will understand the amount of assumptions you put in there. So what we generate from the KGW model For example, we have the valuation of $26, for instance. We put probably hundreds of assumptions in there. All of the parameters you input into the KGW model, the spreadsheet, will lead to that valuation of $26. Okay, we are doing finance. We are not like the mom and dad investors in the market. We are so-called sophisticated users of the financial statements and financial information. So we talk in our term. For example, the risk-free rate. That's a parameter you input into your KGW model. If it's 2.6%, how are we going to model? How are we going to understand that parameter you input into the model? Okay, are we 100% sure that the risk-free rate is going to be 2.6% for the next several decades for the future? We don't know. We don't really know. That's our educated guess. If it's an estimate, and for finance, especially for us, we have been doing finance and statistics for 3 years, there's a distribution of that. And that 2.6% might be just one of these millions of possibilities. So that's only a point estimation of risk-free rate you input into your model. And consider all the other parameters you put in there. Risk-free rate may be the most straightforward one. What about the revenue growth rate? If you have 3% average growth rate for the next 5 years, and also for the 10 years bond valuation period, how likely the average growth rate of the company is going to be 3%? What are the other possibilities? Other possibilities of the revenue growth for the company? It's still a distribution, not necessarily a perfect bell, of course. So for each parameters you have there, hundreds of parameters. Each parameter is only a 1-point estimate out of an unknown distribution. So now let's have a look at that valuation of $26. How much confidence you're going to put on that $26 valuation? If the valuation comes within a distribution, that's only 1-point estimate as well. Maybe we assume it's the most likely outcome as the mean, which is close to the mean, $26 its value, or we really have a confidence interval that we are 67% confident that valuation will fall into this range. So what you generate from your KGW model, that valuation is only one possibility out of millions. And all of the parameters you input into the spreadsheet can be wrong. Because the economic development, the industry structure, the development are random. We have no confidence, we have no certain information how they're going to turn up in the next several years. Of course, for analysts, we do have some confidence in forecasting their earnings for the next 12 months. But we are valuing the company for very long-term time frame. So, sensitivity and scenario analysis will help us to understand that distribution, the possibilities of the valuation instead of just 1-point estimate or our central estimation of the value or our most likely outcome of the company. Sensitivity analysis means that we go to examine our model and we go to change some parameters and see how the other parts of the model and the final valuation will change. Let's do some exercise. Maybe risk-free rate or the risk-free rate. That's probably the most straightforward and easiest parameter. Is Woolies value sensitive to risk-free rate? Is Woolies value sensitive to risk-free rate? Which kind of industries or companies value are very sensitive to interest rate? Now, Reserve Bank of Australia has been discussing in the latest statement of monetary policy, we're going to keep the 1.5% policy cash rate on hold, and it's well believed it's going to be like this for the next 12 months. If you consider the management of all of the listed companies in Australia, the management from what kind of companies are really focusing on that interest rate movement? Yes. Excellent. Yes, banks. The value of banks are very sensitive to interest rate. Is Woolies sensitive to interest rate? Maybe not. Maybe not. Why? Why? An increase of 50 basis points of target interest rate will lead to what changes in the financial market? If Reserve Bank does believe we really have a robust economic development and the this increasing trend of the interest rate in all of the major economies, they tend to increase interest rate as well. And now we have very much expected inflation at the lower end of their target inflation rate. So it's very likely the next move will be increasing the interest rate. So increasing the target cash rate by 50 basis points will increase what? What? Huh? Yes, the bond yield. So the company will have to buy higher interest rate from the market, no matter it's corporate bonds in the US or corporate notes in the Australian and US market. Higher discount rate, that's what fit into WACC. And what else? When we think about valuation, we think about discount rate and what else? The cash flow. Is Woolies cash flow sensitive to interest rate movement like 50 basis points? Not very much. Yeah. Yes, exactly. But if the Reserve Bank does decide to increase interest rate by 50 basis points, that means they are very confident of the GDP growth. Yes. So you won't see much changes with the cash flow, but a very minor increase of discount rate. And we understand because of it's the nature of the trade, the business, it's not sensitive to risk-free rate or interest rate movement. Now, if you go to your model and increase the risk-free rate or other parameters of your WACC estimate by a small margin, a possible margin, for instance, the increase of interest rate or risk-free rate is not going to be like 1%. No, it doesn't happen like that. If you do a small change and you see your valuation from $26 drop to $21, that indicates something wrong with your model. Because Woolies shouldn't be that sensitive to risk-free rate or just a minor increase of discount rate. That's how we might run the sensitivity analysis. It's not like, okay, we have these key parameters. Let's go to do a laundry list. Let's go through all of the parameters. We generate a nice table, changing the risk-free rate, changing beta, changing the revenue growth rate, margin. Let's generate a nice table. But how are you going to interpret the output from this sensitivity analysis? Do you really understand it? Sensitivity analysis is applied to help you to diagnose your enterprise DCF valuation model, in addition to ROIC. I see group 8 is here, is good. Consider your model. What's the most sensitive parameter in your model? Consider the difficulties you have, your manipulation of your model, and the trial and error you have been playing with your model. Consider the key parameters in your model of Woolies. Which one is the most sensitive one? Which one? Huh? Sorry? What? If you're going to run a sensitivity analysis, there are lots of parameters you want to test about. So which parameter is at higher risk will be at the top of your priority list. We discussed the problem of your model yesterday. What's the problem? What? Margin. Yes, exactly. That's the weak point of your model. There's a reason for that. See if we can get the document camera switched off. It's a little blinking, I don't know why. So we have the value of Woolies at the center of our problem we try to solve. And after playing with the model and the model diagnosis, we understand, I think your model is like $26 or $25, right? Okay, that's fine, you don't remember. Your value. What's the output of your model? Okay, that's fine. That's fine. Yeah, 20 something. So we have applied of ROIC analysis, try to diagnose our model. So we understand that $26 of value is driven by the margin of about 5, 6, or even 7% forecasted, and capital turnover of like close to 2 to 3 times, depending really on your model. And we have a WACC close to 7 or 6. Some groups forecast a little bit higher, but it doesn't matter. And the ROIC, including goodwill, that's the overall ROIC of the whole company, should be a little bit over 10%. So that's what we have so far. And let's consider how the value of the company will be most sensitive to. Now, we just had a discussion of WACC. Maybe not all of these will have a large impact on the value of the firm, unless we are in a recession, a real recession, not a technical recession. So that's probably not very likely to happen. There might be a small chance, like maybe 5, depending on your belief. I believe it might be a 5% triggered by the housing market changes. And the company's ROIC is about 12, 13%. There's a very nice spread of ROIC over WACC. So given this, let's consider the value the underlying operation of the company will be most sensitive to which driver? Actually, we are looking at margin, turnover, and WACC. Which will be the most sensitive parameter for the value of Woolies? Which parameter has been really stable and it's really difficult to push further? If you had some understanding of the company's competitive position within the industry, how does it generate its value? From higher margin or higher turnover? Higher margin or higher turnover? Is it margin? Do they have the power to charge higher price? Or perhaps just really push the suppliers to reduce the price by very large margin? Is it the margin? What are they doing? Voice of customers, rolling out new shops, closing up underperforming shops. What are they doing? What are they doing? Are they pushing margin or turnover? Turnover. The margin side on that front, it's very hard for them to charge a 10%, 15% or 20% margin like the pharmaceutical companies or healthcare device companies. They are doing the corporate strategies are focusing on generating more revenue for each dollar capex. They are focusing on turnover. Okay, so that's how they create value for shareholders. But when we try to understand our value, obviously, it's going to be determined by the success of their approaches of generating more revenue for each store. Margin. Now we are doing something different. Any 1% increase, like the margin changes from currently 5 to 6% to a territory of 8 or 9%. That's what you have forecasted will lead your value to jump or slump. And that's the weakness of your valuation model. How likely is the company going to increase the margin from 6 to 9%? They have a few possible approaches. For example, increase the price. Are they really increasing the price on the shelf? No, not at all. The management has been discussing price deflation. They're trying very hard to keep the price down, down, down. That's the advertisement from Coles. Are they able to push that margin from 6% to 9% by pushing really hard the suppliers to reduce the supply cost? Coles has settled a lawsuit with ACCC because of this ethical, illegal, maybe, dealings with the suppliers. Woolworths get away from it, but we don't know what happened behind the scene. So they are not, the suppliers in general, they're not very happy about the two big players in the grocery market. Increasing the margin by increasing the operational efficiencies, by reducing the administration cost, corporate overhead. Is it that simple? To reducing the wages, reducing the running cost of the company to push margin from 6 to 9%. It's not very likely. Yes? Now they have a portfolio of retail, food retail, Big W and liquor and hotel. They have disposed the whole excuse me, hardware and home improvement. They are more cyclical. They are more cyclical. They are trying to reducing the risk of its portfolio of assets and become more focused on the retail staples. They are really focusing on Australian food. Over the margin, you're right in the sense that the margin of the hardware and home improvement has been suffering because they're related to the building materials. They are really very cyclical and they really not very much competitive advantage within that trade. That's the management mentioned about disposing any business units further, except the petrol. No, not really. So what we have now in your model of the operating assets are probably most likely the portfolio of assets going forward, so excluding the petrol business. So when we run the sensitivity analysis, it's not doing a laundry list. You need to understand your company, how does it generate value, and should this value of Woolworths be sensitive to which parameter and why? This is running sensitivity analysis. Of course, you can do your own play and just test your ideas and just have a play and have a look at how you might change this and then have a look at your value. And this, when you identify a sensitive parameter that will change your value very much, that gives you better ideas of the possible distribution of your value given the changes in the margin. And that might provide you a story for your report writing. Okay, let me talk about this. I'm still hesitating giving you any very specific indicators of this kind of thing. Consider the competitive pressure within the food retail in Australia. If the value of Woolworths is largely relying on the margin, what about there's a new entrant? What about the store rollout of Aldi? The discounter is extremely successful. And if customers can buy similar quality products at a very much discount at Aldi, and customers will have similar, maybe not at the level as Coles and Woolworths customer service on their floor, you're going to see an erosion of market share of Woolworths. Market share, that's a change of the turnover, and when you consider margin, when you lose customers, it also affects your margin as well because you have large amount of fixed investment or fixed cost for each shop. And now you are generating less revenue from each shop. That will affect your margin as well. That will give you some ideas of a future scenario that the competitiveness structure within the industry might change. What are the relevant scenarios? Okay, if you have a forecasting model based on inflation rate plus a forecasted real revenue growth. Okay, real revenue growth. If I'm going to use the real GDP growth as a proxy of the real revenue growth, okay, it's very simple. I assume, okay, one scenario of 5% of chance of a recession, and we have 1% GDP growth rate, 8% unemployment rate, and that will fit into your forecasted revenue growth of maybe changes from 4% to 2%. Okay, that's one scenario. And another scenario, 90% was still like this. And another 5% scenario that we're going to really have extremely successful economy. We have extremely robust economic development on every aspect of the country, and that will fit into your forecast or revenue as well. Are you going to define your scenarios like this? GDP growth rate. Are you going to define your scenarios like this? You may argue that, okay, yeah, the company operates in Australia, generates 90% of its revenue from Australian market, from Australian customers. GDP growth is related to the value of the company. But ask you twice, that value is the net outcome of the company's corporate strategy, industry structure, and the macroeconomic development. Now, in your model, you only incorporate only the macroeconomic model. That will be, there's a smaller circle of industry and a larger circle of economy. So, ignoring industry and the corporate strategies in place of the company is not a really good model. So defining your scenarios by simply forecasting different GDP growth rates is not a really very relevant scenario for Woolworths. That's what we have observed from the students' assignments in the past years. I'll just give you warning. This is not a good scenario analysis, not a good scenario definition by forecasting different rate of GDP. Then where do we start to define scenarios? Where do we start to define your scenarios? What are the relevant factors of value? Don't forget the relevant factors of the value. Consider your model. What are the relevant factors? What framework do we have to understand value of a company? It's right up there. ROIC, the drivers of ROIC. How can we incorporate this in this definition of scenario and analyze different scenarios for your model? Consider your model. Let's discuss an example of store rollout. So if I forecast the revenue of each business segment of Woolies by store rolling out plan of the company. So you're going to calculate the per store revenue forecasted for the next several years, at least for the next 5 years, and you apply a discount to the new stores and you impose your judgment in there to allow the store to catch up with the existing stores to generate the average revenue per store. So that is my model of forecasting revenue. And I will maintain the margin of around 6%, given that there will be no substantial changes of market share of Woolies. That's my central scenario on how I can generate the value of $26 in that large distribution. What might go wrong with this scenario? What might go wrong with this scenario? Yes, exactly. increasing competition. How does the increased competition will affect your forecasting model based on store rollout? You're forecasting 10 to 15 new shops every year for the next 15 years. What will the increased competition impact on your store rollout? Exactly, yes, excellent. So now, based on the management plan, they have certain number of shops, new shops for each business segment, the store rollout, and build this into your model. What if there's increased competition? Aldi has been aggressive and they have doing a lot of things to improve the customer's experience when shopping at Aldi stores, and they are having something in place to improve the operation as well, but at the same time, maintain the operation efficiency and the low shelf price. What if Aldi has been really successful and have an expansion plan much more successful, much faster than Coles and Woolworths? For the management of Woolies, you'll see that, okay, our original plan at the end of financial year 2018, we have the plan of opening up 10 to 15 new shops, Woolies shops every year. Now, we can't really do that because the more shops you open, you really need to attract this amount of customers to buy from your shop. But because of the competitors are doing really well, customers will still choose to go to shop at new Aldi stores. So now, given the increased competition, the management of Woolies has to reconsider their store rollout plan. They're going to change the store rollout for from 10 to 15 shops to 5, 8. What's the possibility there? To maintain the value they can create from each existing shop or new shop. And also the increased competition will have some impact, not just the store rollout, also for the per store revenue as well. Put your judgment in there, and that's how we can define a relevant scenario based on the important determinants or drivers of the value of the company. There are other possibilities. This is only one way to define the scenario and work out how this will going to fit into your revenue forecast margin. And another warning is that, okay, I'm going to incorporate the increased competition into my model by just changing the revenue growth. I assume, okay, I'm going to have 2 or 3 new stores every year because of the competition from Aldi and Coles as well, and maybe the new smaller competitors in the market as well. That's it. I'll just go to change the revenue growth rate. Is that possible? That the company only is affected by revenue competition from the revenue front? What about margin? What about margin? What about other dimensions, other aspects of the business? Are they going to be affected by the increased competition? And in what way? So the company is not static, it's not a stone, it's not a piece of furniture, it's a living, organic thing. It's always changing, and the management is always changing their corporate strategies. So if you do define a scenario as the increased competition, the much stronger competition from Aldi, the discounter, what will expect the management will do? business structure is too general. You have to go down, really down to the debt. How might the company management will do to, given the increased competition from Aldi? So in terms of the store rollout, they may shrink their capex a little bit. Pricing, yes, pricing. They have other things within their discretion, although they might be tied up with this kind of pricing thing. What are they going to do with the margin? So what we see from the annual report are numbers. Behind the numbers are decisions, analysis, based on the actions of the competitors. It's not a static process. So make sure when you define a scenario, you'll consider other aspects of the company and incorporate these analysis, incorporate these possible changes into your model. It doesn't, scenario analysis, it doesn't mean in a way that, okay, this increased competition, reduced scale of capex and the slower revenue growth and lower value. That's probably not the most likely outcome given one parameter change. There are other things that the management can do, and you put your judgment in there, given your understanding of the company and its industry. So on these slides of this lecture, there's something that's a laundry list. You will find a laundry list. Only test the relevant things or interesting things for your for your evaluation. That's not required. When we have the calculation capacity, we can do a random draw of each of the parameters. That's hundreds of parameters into your KTW model. We can generate a distribution of your valuation, or every single ratios or ROIC parameters generate a distribution for each of these analysis parameters or financial ratios. So that will give you a better ideas of the possibilities, the whole distribution. But doing so, you are introducing more uncertainties. So how you're going to rely on that distribution to decide your valuation is still a question mark. We have discussed this scenario analysis using the application of, in the Woolies case, these are just some principles or guidelines you may go through, but I have discussed all of the topics with Woolies example. Here's the Telstra scenario analysis. It's a scenario analysis of the success of the NBN negotiation. It's produced well before this, the settlement of the NBN negotiation. You may have a look at the success rate for each scenario and how each scenario is defined. It's not one parameter play. Each one scenario can be defined by several other parameters as well. The company got its multiple dimensions. One scenario will see one outcome, and within each scenario, there's also some possibilities of defining sub-scenarios. So here you will have look at all the scenarios and the possible outcome of the company operation, of the assumed margins and market share. Yes. Your judgment. After all of the training of playing with the KGW model and doing all of the research of the company, the industry, you're good enough to decide the scenario, the weights. That's an example of, we have discussed in week 6 of a company believe, okay, there's a very strong market demand of their products, and they are thinking of, okay, we build another new plant. And that's the case for a lot of industries, CapEx. Large amount of investment happens on the top of the cycle. So that's what happens. 9 players within the industry build new capacity at the same time. So if you have a look at this series of analysis, you will see if competitors build the plant, that company you're trying to value will suffer from pricing or margin, and the how fast the additional products can be absorbed by the customer demand, and that will destroy value if all of the major players build new capacity at the same time. That's exactly what happened to building material companies back in 2000, around the housing boom in Australia. So after that, there was a consolidation within the industry, merger acquisitions, and some squeeze of the excess capacity within the industry. And they were shifting the focus of pricing to operation efficiency. There were some really big changes within building material industry after 2000. How can we build this into your scenario analysis? I have discussed, if you model the company by store rollout, the way that you incorporate competition should be something like this. You have to define how the number of years your new shops will catch up with the existing shops. If you are forecasting your revenue by top-down method, in which the market share is the key input into the forecast of the revenue and the margin, in this case, you have to define a scenario still by the competitive structure of the industry going forward, and also the relative strength of the company is able to maintain the current market share of around 37% in Australian food retail. You got to build this into your scenario. And at the same time, don't forget the action or reaction of the competitors. Otherwise, the valuation you produce will be wrong. This is a graph to show that the more capacity you build, the more capacity is being utilized in the economy, the lower pricing you have. And that will an erosion of the margin. It's a further analysis of the company and its competitor build new plants, and you will see an even bigger value loss for the industry, not just for the company. It takes much longer time for the new products, new supply into the market can be absorbed by the customer demand. Here's the ROIC is over here. So it takes much longer for the company to generate ROIC above its WACC. Another laundry list for your scenario analysis. These are might be some considerations for any company, but for your company, you got to find out the relevant scenario and define the scenario and carry out the analysis based on the existing structure of your DCF valuation model. So for the assignment 2, sensitivity analysis is optional, and I think Group 8 has already got some good understanding of how sensitive your model will be to margin. And that scenario analysis is compulsory. You have to understand that your estimate, that's 1 point estimate of whatever the value will be, is only one possibility out of millions. You got to define just one dimension of your scenario analysis will be good enough to give you the chance to do this exercise. Define one scenario, not one scenario, on one dimension. Just apply this scenario analysis on one of your forecasting models and find out the possibilities of your valuation. Of course, you're not expecting to generate a distribution, not really a distribution, but the possibilities. I give some specific hints or directions that you might apply scenario or sensitivity analysis on Woolworths. And you probably, when you try to do this additional analysis, you will find sensitivity analysis and scenario analysis, they can be correlated. They can be overlapping. That's pretty much normal for any quantitative analysis. Whenever you got to change a parameter, other parts of the model will change. So it's okay that you run this sensitivity and scenario sort of combined, mixed up, and that will give you rich information of how the value, your central estimate, might be wrong, and what will be the lower bound and upper bound given your defined scenario. So still, I don't want to try to prescribe a correct way of doing this, and you probably will have found out my feedback on your assignment 1, especially for your forecast model, are totally based on the suggested improvement on your existing forecast model. There are lots of ways of forecasting, and I don't want to push you to adopt one correct way. So you will get very similar level of exposure of problem-solving skills and thinking like an analyst for any model you adopt. So there's still no correct way of defining scenarios, and you work it out in your own model. Next week, we're going to discuss some preparations for writing up your valuation report. There are some new resources available on this topic on Water. I uploaded this week. You may have a look at the elements of a research report. It's still another laundry list. You may select a few of these sections to read or some materials to spend more time on. We're going to discuss in more details next week. Make sure you have started working on the multiple valuation now, this week. This week and next week, try to finish the multiple valuation and come to talk to me if anything is not clear, if you want to clarify any requirements of the assignment. Read the last page of the assignment guideline. It gives you the marking criteria of assignment 1 to give you directions of how much you're going to spend your energy on these different segments, different elements to have a better grade. Okay, thank you very much. That's it for today.